Let's check on the markets. They open up in a bit over an hour's time. Stephen Daghlian, good morning. How do we open up today?
Good morning, Peter. Well, I think it's actually going to be a pretty good start for our market. Thankfully, we're set to lift by approximately 1.5% in early trade. That would be enough to recoup most of this week's declines, and it could certainly change the story for how we talk about September in the next couple of days. The reason for the gains actually came overnight. The US market had its best day since early August. It was up over around that 2% mark. Now, the catalyst was actually the UK. The Bank of England surprised everyone by announcing plans to actually calm financial markets over the next 2 weeks by buying an unlimited amount of longer-term government bonds. And that was off the back of Prime Minister Liz Truss's tax cut plans, which has been pushing up borrowing costs substantially there and creating concerns for pension funds as well that hold billions in government debt as well. So that basically what it's done is created some optimism that perhaps central banks around the world might eventually cave in and try to help their markets if things get bad enough in those parts of the world. That might not end up happening at all, but it's how our markets ended up responding. Now, today's going to be a huge day for markets, Peter. We've got a lot going on. Over $8 billion will be paid out in dividends today. Most of that will be from Fortescue Metals and CBA, but Northern Star, Ramsay Health Care, Newcrest Mining will as well. We had the government, of course, the government's 6-month fuel tax cut being, ending last night. So that's going to probably add something like 25 cents per litre to petrol prices in coming weeks. We've also got a monthly update on inflation, which will be out today. Not as extensive as the quarterly report out next month, but it certainly will still be important for economists and analysts to look through. The Aussie dollar, 65.2 USP.
Okay, Stephen Daghlian, thank you.